A low monthly car payment can still quietly steal 6 figures of future wealth. That sounds dramatic, but the payment is only one piece of the real cost. A brand new car can bring depreciation, interest, insurance, taxes, registration, maintenance, and opportunity cost. This is Money Hacks USA, where we make your money work smarter. The goal is not to shame anyone for wanting a reliable car. The goal is to make the full price visible before the dealership turns it into one comfortable monthly number. Today, we will break down the true cost of buying new, why depreciation hits so hard, how financing changes the math, and how to buy transportation without letting it dominate your financial life. Dealership math often starts with the monthly payment because that feels easier than the full price. A $650 payment may sound manageable if your paycheck is strong, but $650 for 72 months is $46,800 before considering insurance, registration, fuel, maintenance, and repairs. If the loan is stretched to 84 months, the payment may look smaller, but you are in debt for 7 years. That is a long time for a car that is losing value every month. A lower payment can come from a bigger down payment, a longer loan, a lower rate, or a cheaper car. Only one of those truly reduces the price. When you negotiate based only on payment, you may miss the total cost, the interest rate, and the add-ons hiding inside the deal. Depreciation is the value your car loses over time, and new cars usually lose a lot early. The exact amount depends on the model, mileage, market conditions, and demand, so do not trust one universal number. But it is common for a new car to lose thousands of dollars in value during the first few years. If you buy a car for $40,000 and it is worth $30,000 after a few years, that is $10,000 of value gone, even if the car still runs perfectly. Depreciation is not a monthly bill, so people ignore it, but it is real. You feel it when you trade in, sell, or discover you owe more than the car is worth. That is called being underwater, and it can trap people in bad car deals. Financing can make a new car much more expensive than the sticker price. Suppose you finance $38,000 for 72 months at 7% APR. The payment is roughly $648 per month, and total interest can be around $8,600 over the life of the loan. That means the financed cost is closer to $46,600, not counting taxes and fees. If the rate is higher because of credit score, the cost can climb even more. This is why credit score matters before car shopping. A difference of a few percentage points can mean thousands of dollars. Also, rolling old debt into a new loan makes the cycle worse. If you owe $4,000 more than your trade-in is worth and roll it into the next car, you are paying for 2 cars with one loan. New cars often cost more to insure because they cost more to replace or repair. Full coverage may be required if you finance, and newer vehicles can have expensive sensors, cameras, and parts. A bumper repair that used to be simple can become costly if it includes driver assistance technology. Then come taxes, title, registration, documentation fees, destination charges, and optional add-ons. A car advertised at $39,995 can become much more by the time you sign. Extended warranties, gap insurance, paint protection, wheel packages, and maintenance plans may be useful in some cases, but they are often sold when emotions are high. Ask for the out-the-door price, not just the monthly payment. That number includes the car, taxes, fees, and extras, which makes comparison much easier. The biggest hidden cost is what the money could have done instead. If you spend $700 a month on a new car payment, that money cannot also build savings, pay down credit cards, fund a Roth IRA, or help with a home down payment. Imagine investing $300 a month for 30 years at a 7% average annual return. That could grow to roughly $366,000. Not guaranteed, but it shows the scale of opportunity cost. Cars are useful, but they are usually depreciating assets. The more of your income they consume, the less room you have for assets that can grow. A reliable used car, a shorter loan, a larger down payment, or keeping your current car longer can create a powerful gap between what transportation costs and what your future keeps. A smarter car decision starts before the test drive. Set a maximum out-the-door price, not just a payment. Get financing quotes from a credit union or bank before going to the dealer so you have a baseline. Check insurance quotes before buying, not after. Avoid loans so long that you are still paying heavily after the warranty is gone. Consider certified used or lightly used vehicles if the numbers make sense. Put enough down to reduce the risk of being underwater, especially if the car depreciates quickly. Get any used car inspected by a trusted mechanic when possible. And remember that the best car is not the one with the most features. It is the one that reliably fits your life without wrecking your cash flow. Here is the real car math. A low monthly payment does not automatically mean an affordable car. Look at the full price, loan length, interest, depreciation, insurance, taxes, fees, and opportunity cost. Ask for the out-the-door price, compare financing before the dealership, check insurance quotes, and be careful with long loans or rolled-over debt. A car should help you get to work and live your life, not quietly block savings and investing for 7 years. Subscribe to Money Hacks USA for more practical money decisions that protect your future. The free tools and resources in the description support the channel at no extra cost to you. Risk comes from not knowing what you are doing. Warren Buffett.